Michael Farr, CEO of Farr, Miller & Washington, and a CNBC contributor is with us. Also, Bryn Talkington, managing partner of Requisite Capital Management. Welcome to both of you. Bryn, I'm going to start with you because my note indicates that you told our producer that this was the worst rate move ever, by which you mean it was ill-advised. We have a health crisis, not a liquidity crisis. Are we just overdoing this and overreacting to this?
Yeah, thanks, Tyler. I mean, I think absolutely. You know, when the Fed has done their surprise moves in the past, it's because we had a liquidity crisis. You know, looking back at long-term capital management, you know, what we have today really in the market is a knowledge gap. And no one really knows the short and midterm implications of this virus. And I think that the Fed preempting everything and using 50 basis points when rates were already low, you know, gives them less ammunition in going forward to do other things. And so I definitely think it was ill-advised. I think we all know we have a health crisis, not a liquidity crisis. And I don't see what the Fed intervening, doing a surprise rate today, does to try to give confidence, because markets are not settled and liquidity in the market will have nothing to do with getting a vaccine, you know, for the coronavirus.
We've got, Michael, the financial market reaction. We've got the Fed reaction here. We've got a political reaction from candidates and the president and his team. Are we making too much of this?
We don't know, Tyler. It doesn't look like it. I think you have to take seriously the warnings from the CDC and the World Health Organization when it comes to a matter of health. We know that factories in China have been shut down for a long time, and they haven't been producing parts necessary to a lot of other operations and manufacturing around the world. We know that there's an economic slowdown that's significant in the world's second largest economy. We don't know how that's going to affect us here in the United States, but we can listen to our experts. This is a time where as an investor, you have to be data dependent. You just have to not trade the facts until you see the facts, and don't let emotion get the best of you.
I saw Bryn. I saw you nodding there. What about gold? It was up today. Jim Cramer likes it at these levels, thinks it's a place to put money. Let me get both of your thoughts quickly on gold. Bryn, you first.
Yeah, sure. We own gold. We've been investors in gold. And I think that, you know, as soon as the Fed surprise rate cut came out, you know, gold moved higher. And I think as long as the market sentiment thinks that the Fed is going to start acting more like Europe and Japan, then gold is going to continue to catch a bid, because I think there's going to be that trade out there that people think fiscal and monetary policy just isn't going to be as effective as it was as you get closer to that zero bound.
Michael, quick thought there. Gold, yes or no? Has it got a place in your portfolio?
No, not for me, Tyler. I can't figure out fundamental value of gold or why it should be at any particular price. So I know that it'll receive a lot of dollars in a state of panic, but other than that, or inflation, but I can't figure out a fundamental value, so I don't do it.